We now turn to static risk measures with a focus on US Treasuries. In this module, we'll look at traditional measures as well as some advanced measures. And so we'll review the traditional bond risk measures. We'll explore the role of compounding. Turns out discrete or continuous applies is an issue with both holding period returns as well as with bond valuation. And the choices there sometimes have implications to the kind of analysis that can be done and which one's more efficient. We'll review some selected empirical evidence. I'll introduce a LSC-based bond risk measures that are focused on holding period returns. So if a particular bond has a set holding period return over, say, the last month, we want to be able to decompose that into different component parts. And we'll illustrate that selected LSC applications. So the central finance concepts, we'll look at the origins of bond risk management, some of the traditional bond static risk measures definitions, and we'll explore this idea of immunization. Immunization is one of the most powerful tools in debt-related finance. The history, as far as the farthest back I can go, is a guy named Lidstone. He had some of the earliest known writings on the duration concept. His mathematics was quite impressive, and he understood many things. Macaulay is usually given the credit for defining duration as a measure of longness, a weighted average of when, a present value weighted average of when you'll receive cash flows. Reddington in 1952 introduced the concept of immunization. That is, if you seek to balance both the asset interest rate sensitivity against the liability-based interest rate sensitivity, you can go a long way to eliminating interest rate risk exposure. The concept of immunization is widely applied in the banking industry as well as in the insurance industry. Interesting to me is that it's not widely deployed when it comes to investment management. And why that's a surprise to me is because I'm not aware of any portfolio of assets that doesn't have a corresponding liability that it's seeking to fund. So Macaulay duration is a present value weighted average of time to cash flow. Modified duration is closely related, but it's a percentage change in the bond price or portfolio for a given change in the yield to maturity. This is not an elasticity, it's simply the percentage change in the bond price divided by a given change in the yield to maturity. Effective duration is a cash flow adjusted percentage change in the bond price or portfolio for a given change in yield to maturity. Effective duration is significantly different than modified duration when interest rates have cash flow effects, such as mortgage-backed securities or other kind of interest-sensitive cash flows. Standard convexity measures the curvature of the price-yield relationship. It captures most of what duration misses, and effective convexity is simply the cash flow adjusted measure of the curvature of the price-yield relationship. Hicks introduced an elasticity measure. He had early thoughts on the issue related to immunization. He defined elasticity as the average length of time for which various payments are deferred from the present when the time of deferments are weighted by the discounted value of the payments. Samuelson noted that increased interest rates will help any organization whose weighted average of time period of disbursements is greater than the average time period of its receipts. So Samuelson recognized that it's the imbalance between the interest rate sensitivity of assets and liabilities that causes risk. According to Poitras, Samuelson's work was an extension of Hicks in anticipation of Reddington. Reddington's immunization and investment of assets in such a way that the existing business is immune to general changes in interest rates. The first derivative is the most important for small changes in interest rates. In different terms, he noted that asset convexity needs to exceed liability convexity. And so Reddington really laid the groundwork for a lot of the analysis that we'll do in this particular chapter. Just to make sure we're clear on what this idea of immunization and how it connects to duration, I don't want to take the time to go through this figure, but this is in the materials provided. If you can understand this particular chart on slide 10, you'll go a long way to understanding how interest rates affect portfolio performance. So let's consider we had a 4-year, 10% annual coupon paying bond with a yield to maturity of 8.5. Current bond prices say 104.913. And the key is it has a duration of 3.5 years. Now, if we hold that bond for 3.5 years, what we'll notice is regardless of what happens to interest rates, if they go from 8.5 down to 3 or 8.5 up to 14, basically you earn 8.5. This is why Reddington referred to the portfolio as being immunized. That is, it is insensitive to changes in interest rates. Now, the actual calculations of these yields is quite complicated. The assumption is these rates change once and only once at the very beginning of the period, and then you have to compound them out. If we compare this insensitivity to interest rates to a zero coupon bond, which has a longer duration, what we notice is if interest rates fall, the holding period return over that 3.5 years is actually in excess of 8.5%. And if interest rates go up, then the performance is less than 8.5%. So if I'm holding a zero coupon bond and I have a horizon of 3.5 years, my hope is that rates go down. Now, interestingly, if I have a 20% coupon bond, which is going to have a shorter duration of 3.24 years, what you'll notice is you get exactly the opposite pattern. If interest rates go up, I get outperformance, but if interest rates go down, I get underperformance. And so when someone asks, do you hope rates go up or down, the only answer you can really give is it depends. It depends on whether I have a horizon longer than the 3.5 years or shorter than 3.5 years. And so the mere movement of interest rates does not indicate whether or not your enterprise is better or worse off. One interesting anecdote in 2022 and 2023, when interest rates sharply went up, there was many headlines in reputable newspapers like the Wall Street Journal suggesting that pension funds have been clobbered and their asset values have gone way down. And in fact, they have gone way down. But their liabilities, the present value of their liability stream, went down a whole lot more. And so actually, these defined benefit plans are much better off in this higher rate environment. And so in the area of the debt market, things are not always as they appear. Now let's turn to some of the more quantitative material. We're going to look at the traditional valuations and static risk measures. Remember, traditional valuations we've covered already in Chapter 4. We'll make sure we're clear on discrete versus continuous compounding, how that influences valuation and holding period returns. We'll look at some empirical evidence. Just note, we're not going to go deep into this issue of embedded optionality, but things like default risk and callable bonds affect the performance of bond holding period returns. And then we're going to apply the LSC model and examine some of the performance measures that can be derived. So in the case, just like we had when we were valuing bonds, we have a coupon, we have the number of coupons per year, par, fraction of the payment period elapsed already since the last coupon payment, number of remaining cash flows, and then we have the coupon payment on each payment date, and then the final payment is the coupon plus par. And so the traditional valuation formula using discretely compounding looks something like this. The M on a semi-annual bond would be simply 2. And then remember, this F is the fraction of the period that has elapsed already. And this is your traditional bond valuation. Remember, the bond valuation equation contains both the a quoted price of the bond as well as accrued interest. Modified duration, remember, is just the percentage change in the value of the bond divided by change in the yield. If rates go up, then bond values go down. The tradition has it that you sign this, so the modified duration is represented as a positive number. With discrete compounding, if I take that first derivative, I get a representation like what's given here. And so what we note is that modified duration is very easy to calculate once you have all the right parameters. Standard convexity, similarly, just take the second derivative and then divide it by the value of the bond, and you get a representation this way. Effective duration and effective convexity will incorporate cash flow adjustments. And so what we do is we have to have a valuation model that reflects these cash flow adjustments, and we revalue the bond if rates go down, revalue the bond if rates go up. If this is a mortgage-backed security, when rates go down, you might have refinancing and you have prepayments, which will affect valuation, and therefore this effective convexity would be something different. We're really not going to address effective duration and convexity in this module. With continuous compounding, the discount rate applied to valuation, we continuously compound the discount rate, and so the yield to maturity under continuous compounding is basically the R that solves this valuation equation, where discounting is based on continuously compounded rates. And the compounding convention is strictly arbitrary. Remember, what you're trading is the quoted bond price, not the interest rate. And so the interest rate is a derivative of the price, not the other way around. A Macaulay duration with continuous compounding reduces down to a very simple expression. It's simply the weighted average of time to future cash flows, where the weight is a present value weighting scheme. Hicks elasticity measure also reduces down to the same sort of measure. And so it turns out with elasticity, with continuous compounding, you get a similar representation. Reddington, applied a Taylor series approximation. That is, the value of the bond given some change in rate is equal to the value of the bond without the change, first derivative times the change. And in Taylor series, you take 1/2 of the second derivative times the change. And if we stop there, we basically can represent modified duration in this particular way. It's a measure of volatility. That is a percentage change in the bond value for a given change in rates. Standard convexity is represented similarly. And it turns out with discrete compounding, I can represent the holding period return on a particular bond as minus modified duration times the change in yield plus 1/2 convexity times the change in yield squared. Modified duration based on continuously compounding, as we noted before, is simply the weighted average of time. Convexity, it turns out, is just the weighted average of time squared. And it turns out if we take the log value, if we take the Taylor series of the log value, we end up getting a similar representation using continuous compounding. And so we'll stop here on this particular module. There's some empirical evidence that suggests this particular fit is better than the discrete compounding fit. And so you want to use the compounding method that gives you the best answer for your particular problem.